Hello, welcome back. My name is Dr. George Mochocki. You're taking me for an online class, face-to-face class, or a blended class. This is Management 218, and we're covering Chapter 5, Corporate Finance Interest Rates. We talked last Chapter 4 about valuation, income streams, money coming in to the corporation. Finance is one of the largest components of income streams. I want to make money on money. That's what compound finance and interest is going to do for me. I make money on money, so when I need to pay my bills or have a stream of income at a specific time, I know that money's there. The interest rate would be similar to the inflation rate. So if the interest rate is 6%, inflation rate is 4%, I still may be able to make ends meet. If the inflation is like 7% and my interest rate is only 2%, I'm not. I'm falling behind, for lack of better words, in my streams of income. But so let's look at this way. When we're going to look at the interest rates, we're going to just talk generally. And I'm going to, in the chapter, make sure you read the book. The book comes up with good information. It talks about interest rates, talks about inflation, it talks about streams of income. So make sure you utilize the book. This is just going to be a quick overview of the main topics that you need to discuss. I know I kind of just touched on a little things, and someone say, hey, that doesn't make sense. Take my course and we'll explain in a little more detail. All right, so here's what we have. We're going to talk about interest rates quotes and how they're adjusted. We're going to talk about discount rates and loan. We're going to talk about opportunity cost of capital. That means, do I spend the money now or do I hope in the future? Remember, once I have the money tied into something, some kind of long-term investment, getting interest rates on that, I've lost that opportunity cost. I can't use that money because I'm utilizing that money for something else. Let me just turn down my background music. There we go. Okay, and determinants of interest rates, and think of interest rates as price. All right, so this is just generally, I'm going to try to keep this under 20 minutes. So let's see where we're going. Okay, we're going to go. You've got my concept maps. Look at the concept maps, add on to it. I'm just going to give an overview. We discussed this in our discussion board, or we discussed this in our classroom. Okay, so what do we have in interest rates and adjustment? When I look at this in here, oops, let me just close all these up so you know. Got them all open. I apologize. Okay, so sometimes they'll talk in finance, they'll talk about effective annual rate, or what do we call a year, or the annual percentage rate. So what's the difference? The amount earned at the end of the year. That's all it's going to tell me. How much did I make at the end of the year? After I put my money in for investment, and how much interest did I make on that, or money that I made on it that I could utilize or my yield, or my return on my investment. So how much money interest did I make on this investment? Okay, and then page 130 goes a little bit more different. Now they talked about the annual percentage rate. When I look at the annual percentage rate, is interest earned in 1 year without any compounding effect, so it doesn't add on to anything else. So it means 6% APR means 6% divided by 12 months. So when you go and complain, hey, my interest rates are too high. I've got 18 per, I have a 6% interest rate, and everyone else got 3. It's not really bad. You only pay. We're only charging you 0.05%, which is very little. Remember, it's a point of a percentage. So, but overall, when I'm looking at my interest rate, it's just divided. It's not compounding. It just says every month this is how much interest I'm either paying or I'm returning on my investment. At the year end, basically the way the formula comes up, if I have $1 times 0.005%, it will equal to 1.06%. That's my interest rate. So I make 6% on my $1, so I make 6 cents for lack of a better word. And look at page 132, a little more explanation. Now, adjusting the discount rate for different periods. You understand that I have to adjust my rate depending if I'm looking at it daily, if I'm looking at it quarterly, monthly, or semi-annually. Oops, it's spelled wrong. Let me correct this. Those who have me on here, and hang on 1 second. Okay, there we go. Let me just go out here. We got that correct. Okay, so adjusting it at different times. So you may want to know, hey, how much interest did I make on a daily like we looked over here when it says only 0.05 when it goes monthly, but then how do I break that down on a daily amount interest that I make? Some people want that. A lot of most businesses are you basically looking either quarterly or monthly or semi-annually. That's otherwise the numbers are too small. It's insignificant. Well, I don't want to say it's significant. You get $1 million, it makes a big difference. But overall, they're looking at more of a monthly and semi-annually. All right. Now, simple interest. When I look at simple interest, interest earned without any compounding. That's all we're talking about. Simple interest. I know compound. I give you $100, and then at the end of the month, how much? At the end of the year, or whatever agreement I came with you, how much did I make extra on that? Or in this case, it'd be 6 cents on the dollar. All right. All right. So let's go. Now we're going to talk about discount rate and loans. Now, when I look at discount rates, again, let's go on discount. Computing your loan payments. Again, utilize your calculator. It'll tell you how much my payments are. Remember, you had the financial calculator with the book, or I like it kind of using my my old BA2 Plus financial calculator by Texas Instruments. It has all the formulas in there. So now I'm going to come in there. I'm going to say, okay, how much is going to be my loan payments? I could put the interest in there and how much I want, how many years, and it's going to tell me how much I'm going to pay at the end of every month. That takes my principal amount that I'm paying off and my interest amount. Remember, you have to look at it. Over 5 years, you have amortization. That means you're going to pay some for the principal and some for towards the interest or the usage of the money. Now, if you don't have amortization, if it's under 5 years, basically a lot of banks will do. They want you to pay all your interest up front, and then it starts paying off your principal. So if you cash in your car within 2 years, you basically pay them all the interest to make some adjustments, but you don't get your principal. The amount you owe on the car never goes down. Okay, other banks pay daily. Car mortgages and loans quoted as APR, annual percentage, with monthly compounding, amortization. Each month you pay interest and some principal. Again, my calculator we talked about. I know I'm going quickly, but remember, interest is a big factor in business. How do I make money on money? Or why do I take a loan? How much do I got to pay back? And how much do I put some money in here is my core, and how do I make money work for me to pay off my bills, my stream of income without me touching my basic amount that I put into the bank. I always have access to that thing with a penalty, but that access is there. I'm just generating money. It's renewable cash, the way I would look at it. If it's compound, if it makes sense, if it doesn't get diluted by inflation or other factors out there. So think of interest rates as price. So if I'm looking at this, price you pay for using your money. Interest rates are set by the market forces. Federal Reserve uses discount rate to pay a bank as indicated of economic forces and used to take money out of the economy. We'll talk about that later on, or when you had economics or management 111 into the business, and we talked about not the fiscal policy, but the Federal Reserve. How does the banking do? The fiscal policy is once a year, spending and taxes. What we're going to be looking at is the Federal Reserve. Now, the Federal Reserve is a private organization, a banking system, prints money for the U.S. dollar, and then it charges us interest for the money that we get back for them. It charges that to the other banks. It charges that back to the government. If I look at the administration now, the Trump administration in the future, if you look into the way everything's being set up, he's going to try to get rid of the Federal Reserve. Will he succeed? I don't know. It's something I'm just throwing these seeds so you get interested in why it's so important. Because then, why are we paying an outside firm to make money, and then and we have to pay interest? Because they're the one controlling the money, controlling how much money is going into the economy, how much money is going out of the economy by the interest rate. If I raise the interest rate or discount rate, it's costing me more for that to utilize that money. So then for lack of better words, I have to. I don't get as much return on that because I have to pay a usury fee for the loan or whatever. Now it works in my favor if I'm basically selling or buying bonds for someone else, and I'm using those bonds, and they're paying me an interest for me to loan them the money. All right, a little confusing, but it's not that hard of a concept. I'm just going over it, just for you, so you have a general idea of what's going on with the interest rate. It's just how do I control money, how I control the stream of income, how do I put something in there, and I make money on money from a business perspective. But then on the flip side, I have to pay my bills. How much interest do I have to pay? And that makes a big difference with what's going on in the economy. Am I paying too much to utilize that money now or in the future? And, I take a loan now. When you take a loan now and you're paying interest, you're basically taking future earnings and you're using it now to basically hopefully increase your return on investment. But what's that usually costing you? Right now, since the interest rates are very low, it's good to take loans out. Why should I use my money? I could use my money and make money on money in other investments outside the U.S. that pays me a higher return on my investment, but I take a loan here at a low interest rate. So if I take a loan here for 3% or 6%, let's say 6%, and I could take put it in some kind of investment and get 12%, and I'm using your money here for 6%, I'm still making 6% on that. So do you see how in finance, it's just not a clear cut of what interest is. It just gives me an indicator how much that money I have to pay, or how much money someone else is willing to pay for utilizing my money, and they're going to pay me a stream of income so they could use the money because they don't have the cash, and I have the cash. I don't in finance. I never want to have that cash sitting there not making any money. But sometimes I have to make decisions to build a new plan so I can get a higher return. I don't have all the cash. I leverage my good name, my good credit, and I get a lower interest rate. So I utilize somebody else's money, and then when I bring my facilities up online, I'm making more than my interest payments are, and it's worked well. That's assuming that the value, when we looked at the value of the currency, is worth for lack of a better word, hopefully it's worth more now than it is in the future. Okay? In a lot of cases, it is, unless we have a recession or depression that throws everything back as a reset in finance. Okay? So, determinants of interest rates, here's what we have. Okay, let's talk about that. We have inflation, a real interest rate versus nominal interest rate. First of all, let's talk about what nominal interest rate. Interest rates quoted by banks, financials, and others, the rate at which your dollars grow if invested in a certain period. Remember, it's you're looking at in 5 years, I'm going to make so much. Okay, you may make so much in 5 years, but what's the value of that currency? What's the value of the property? Did it go up or did it go down? Now, real interest rate, so that's nominal interest rate, okay? Real interest rate, the rate of growth of purchasing power. Here's what I have it. What can I actually purchase with this investment I did in the future after adjusting for inflation? Inflation's always there. And now when I'm looking at these numbers, later on we're going to look at different ways of valuing and looking at is a project positive or negative, and that has to do with inflation. So you're looking at historical data and similar situations to kind of give you an idea what's going on. No one could read in a crystal ball unless you're time traveling. I'm only kidding. I just threw that in. Some people say what's going to happen in the future. Some people have that intuitive instinct that they kind of have a good feeling. If I look at our present administration, whether you like President Trump or not, he kind of has that intuition. He's a business person, different than a politician, so he's looking at this in a different viewpoint that affects me as a business owner, and he understands that in a different limelight than just say the interest rate goes down. What's it actually happening to the economy? What's it happening to stimulate business? What's it happening to stimulate growth in my business? All that makes a big difference. Many of you are going to take student loans. Do I take a student loan now or do I wait 5 years? What's the college degree going to worth in 5 years? What's the cost going to be for money in 5 years? Right now it's cheap. If you could get a loan and everything else and get what you want to do now, when I say cheap, it's low interest rate. I remember when I had to get a mortgage and the interest rate on the best rate I could get is 19%. 19% is a charge card interest rate on a home with poor credit, okay? So it's interesting. It's strategic awareness, strategic intuition, looking at different models, looking at the past. Will the past tell you what's going to have in the future? It may be a good indicator. Where are we in the business cycle? Where are we in the economic cycle? What's happened globally? What's happened internally? All these factors are in there. This is just one of the pieces of tools that a business is utilize it. Okay. And the next one, opportunity costs of a capital, interest rate versus discount rates, cost of the capital, how much do I need the money now? If I don't have the cash and I could leverage, I got good credit rating, I could get a lower interest rates, but I have to pay that back. Okay, best available expected return. You have to have different models. Now you can't do it for the whole company. You're doing it for different projects. Some projects I could pay for. Other projects it's a long term investment. So I figure, hey, okay, why utilize my money? I could use this as cheap, inexpensive. I could utilize somebody else's money. But remember, even with interest rates, and later on we're going to go in there when we talk about, you have to look at the terms and conditions. Could they turn around and say, hey, interest rates are too low, we're going to raise it, here's your money back, and basically we got to raise it up, or pay us now, or take the higher rate. If you look at a line of credit, I have a line of credit. My line of credit is adjustable to the interest rate. I can lock it in. Locking is good. But right now, why lock it in? Because it's lower. But if it starts going up, I may want to lock it in at 5% or 4%. Then I'm safe. I don't think it's going to go lower than that. If anything else in the future, the interest rates may go up, may not. Right now, they're kind of stable with the administration. There's confidence in there. Seems like President Trump, for lack of better words, his administration kind of has a good ear. He has the right people inside the Federal Reserve that kind of look at the economy and some of the he's very outspoken critic against the Federal Reserve. Say, hey, don't raise the interest rates because you're going to stimulate, you're going to slow down the economy, keep it going. Jobs are going down or going up, and that's all. All those are factors that the Federal Reserve has to look like. Remember, when the Federal Reserve gives a discount rate, when it shows you what's a discount rate, that's the best rate the Federal Reserve gives to its bank. That's the supply. It's not the amount you're going to get it for. So if the bank gets it for 3%, darn well, you're not going to get it for 3%. You'll get it for 6%. They had to make money. Remember, interest rate is, when they say price, it's how I'm using the money I borrowed and how do I invest it, or how do I give those same loans out to somebody else at a higher interest rate so I could at least offset my usury costs and still make some money on that. Like it or not, finance is all about the dollars, all about money. Don't look at me like I'm a harsh person. You're basically, what's my next job? That's why I'm going to college. How do I improve my portfolio? So people hire me because I understand that. And remember, interest is just one component of valuation of a corporation, one component of how do I get a stream of income, and one component about my debt to equity ratio, one component, and there's other parts. And for finance, you have to put all these parts together, and you're making those adjustments. So you, at the end, when that project is done, you get a higher return back to you as an organization that you could reinvest back into the company or give back to your shareholders to profits or dividends, for lack of better words. All right, that's about it. Real quickly on this is general. Let's see how many minutes I have on there. 18 minutes. I try to keep this under 20 minutes. I'm just giving you a quick general overview. We'll discuss this a little more in detail with the formulas and everything else. It'll make more sense. Now I'm just, what the hell did he say? He said all this stuff. Look at it, but all I'm trying to do is get your attention. Focus on an interest rate. Understand interest rate. I'm making money on that. How much is going to cost me to take a loan out versus what I think my return is going to be in the future. Right now, if you get a loan either from the government, which I always would recommend first, get your student loans from the government to give you better terms and conditions. Maybe the private sector will have a little higher interest rate by 1%, but you don't have all the terms and conditions. You're better protected with the federal government. Now, the federal government's also tightening down on how much, because there's a lot of student loans out there, how much the interest rate and who will qualify for that. Will you be able to repay them back? All right, so that's about it. So be interested in this. Remember, this is corporate finance, interest rate. Just quick general, just my touch on that. Just a quick overview. Look at the pages, look at everything else. Make sure you know for your test nominal interest rates versus real interest rate. Make sure you know discount rates, what's free interest rate, your yield or your CD term. Sorry, I missed all that. Oh, geez. CD terms, for 2 years will pay you higher rates. Risk-free interest rates, money can be borrowed or lent without a risk over a given period of time. Yield curve, a plot of bond yields or function of bonds and maturity date. I'll talk about bonds in the next chapter. Boy, I must have missed that when I clicked on it. I apologize. I covered it in here. Make sure you look at all this, and then you should do all right. Stop me, go back. Where am I going? Expand. So we covered all this. So you've got everything else. So when you're looking at opportunity cost of capital, right now it's fairly cheap to utilize somebody else's money or inexpensive so I could do my projects and everything else, or do I wait down the road? Remember, inflation is going to cost me more for the goods. If I could get a good loan now and leverage my good credit, my business, my ideas, I'm in a better position now than I would be in the future. But then you have to go how much of a loan I'm taking. Is it 10 years, 5 years, 30 years, 35 years? How much, if I hold out the whole loan at the end, I'm paying a lot of money, maybe 4 or 5 times more than what my principal is. But on the flip side, if I'm borrowing the money to somebody else, hey, I love you. I'm making more money in for the longer term. Remember, two sides of the coin. Again, my name is Dr. George Mochocki. This is Management 218, Chapter 5. Real quick overview on interest rates, and I'll see you, I think, in Chapter 6 is on bonds. Bye.